Hey there, and welcome. So, if you've ever logged into the GST portal, taken one look at all those different ledgers and felt your head start to spin, you are definitely in the right place. Today, we are going to make it all make sense.
Yeah, you see these terms thrown around, cash ledger, credit ledger, liability ledger, and it's just not obvious how they all connect. But I promise you, it's actually way simpler than it looks. We're going to break it all down.
And here it is. This is the secret right here. For this whole explainer, we're just going to think about it like this. You have 3 different wallets, and each one has a very specific job. Once you get this idea, the whole thing is going to click. I guarantee it. All right, let's dive into our very first wallet, the electronic cash ledger. And you know what? This one is probably the easiest one to understand.
Think of this as your own personal digital wallet, right there on the GST portal. It's an account that you top up with your own money, specifically for handling all your GST payments.
So how do you get money into this wallet? Well, just like you'd expect, through normal banking stuff like net banking or electronic transfers like NEFT and RTGS. And what can you spend it on? Basically anything and everything related to GST. The tax itself, any interest, late fees, penalties, you name it, it's your all-purpose payment wallet.
So here's the crucial takeaway. The cash ledger is a direct reflection of the actual money you have put onto the portal. It's your cash, plain and simple, ready to go.
Okay, let's move on to our second wallet, the electronic credit ledger. Now, if the first wallet was your cash, it's best to think of this one more like a gift card or maybe some store credit that you've earned.
Right? So this isn't money you deposited. This is what's called input tax credit, or ITC. It's basically the credit you get back for the GST you've already paid on all your business purchases. It's the system's clever way of making sure you don't end up getting taxed on your taxes.
Now, this credit, it just gets added to your wallet automatically as you and your suppliers file your GST returns. But, and this is a big but, here's the most important rule for this wallet. You can only use this credit to pay off your main GST tax. You can't use it for interest, penalties, or late fees. That is a really critical distinction to remember.
So the bottom line for this one is pretty straightforward. The credit ledger is all about the tax credit you have earned just by running your business.
And that brings us to our third and final item. Now, we've been calling it a wallet, but you know what? It's probably more accurate to think of the electronic liability ledger as simply the bill. This is the official list of exactly what you owe.
So yeah, this ledger doesn't actually hold any money. Instead, it just keeps a running total of all your liabilities. It's the government's official record of your total outstanding bill for any given tax period.
Every time you file your monthly summary return, that's the GSTR3B, this bill gets bigger. It lists everything you owe, your output tax plus any interest or penalties. So how does the number go down? Well, that's easy. By paying it off using your first 2 wallets, the cash and the credit ledgers.
So, to put it as simply as possible, the liability ledger is the final definitive record of the total tax and other dues you have to pay. It's your bill.
Okay, so now we know about our 2 wallets, our cash wallet and our credit wallet, and we have our bill. Let's see exactly how they all work together when it's time to actually pay up.
All right, so the bill arrives. Your liability ledger shows that you owe a grand total of 40,000 rupees for this tax period.
Now here is the golden rule of paying your GST. You always use your earned credit first. I mean, it's like using a gift card before you spend your own cash, right? It just makes sense. So we'll take that 25,000 rupees from our credit ledger and knock down a huge chunk of that bill. So what's left? We're left with a balance of 15,000 rupees. And this is what you pay using the actual money from your electronic cash ledger.
And boom, just like that, the bill is paid off and your liability for the period is down to 0. See? It's a perfect illustration of how the system is designed to work. Use your credit first, then your cash to clear your liability. Simple as that.
Okay, let's just do one last side-by-side comparison to make sure these 3 different ideas are really locked into place for you. This table is a fantastic little summary of everything we've just talked about. But what's really worth pointing out here are a couple of key differences. First, look at that refund allowed row. See how you can only get a refund from your cash ledger? That makes perfect sense because it's your actual money. And then look over at the used for column. It's a great reminder that your credit ledger has that one big restriction. It can only be used to pay the tax itself.
So there you have it, the 3 GST ledgers hopefully completely demystified. Understanding this flow between your cash, your credit, and your bill is absolutely crucial for managing your GST properly, which really just leaves me with one last question for you. Now that you know the rules of the game, are you really making the most of your credit wallet? Thanks for joining me.